Well, hey there, everyone. Happy Tuesday, May 5th, 2026. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast and rainy Redmond, Washington, but still hikeable weather. So as soon as we're done here, I plan to throw on the hiking boots and head out in the woods for a little bit. But in the meantime, shall we look at some charts together? Not a bad day, honestly. Risk on was the word. The S&P closing above 7250 for the first time. We're seeing continued upside as the optimism surrounding a pretty stellar earnings season, to be honest with you. I just read earlier today about 85% of S&P members that have reported so far have beaten expectations for the quarter, which is not bad. That's pretty decent. Volatility remains low. Crude oil prices coming off a bit. The market in the short term, obviously reacting in a very sensitive way, right? Really sensitive to what's happening in the Middle East, but generally kind of shrugging off any sort of instability and sort of looking past elevated crude oil prices. On the Market Misbehavior podcast, by the way, just earlier today, interviewed Jed Ellerbroek. Jed's a portfolio manager at Argent Capital. Really runs a growth portfolio. So we talked a lot about AI valuations, talked a lot about managing money through this sort of period of market uncertainty. It's a really good thoughts about valuations, about secular trends. That episode should be out to you later this week. While you're waiting for that one to post, make sure you listen to my interviews from last week with Bruce Fraser, Wyckoff expert, and Tom Bowley, generally awesome stock charts contributor. Both really fun conversations with some great little nuggets of wisdom about charting and technical analysis and relative strength. We're live streaming on Facebook, LinkedIn, YouTube, and X. If you're tuning in live, please feel free to ask questions as we go. And sorry, I'm on the wrong page. Let's start with I was looking at the charts before we got started here. Let's look at the market recap. 3 parts to the show. We'll start with a quick market recap and check in on what happened in this risk-on day here on Tuesday. We will then look at the heat map and look at some individual stock themes. Still quite a bit of earnings happening this week as we kind of get through the bulk of this current earnings season. Overall, as I mentioned, it's been pretty positive. Not everything's gone up. Looking at you, Palantir, post earnings, but we'll highlight some names on the move. Then we'll get some individual charts that I've hand selected to review with all of you. S&P 500, as I mentioned, closing above 7250. So we keep making new highs, right? And I was taught the most bullish thing the market can do is go up. So we keep making higher highs. We keep making higher lows. That's generally bullish. If you ask me why I've been bearish earlier this year and now sound pretty bullish, because the market's going up and because the market's making new highs. And that's generally means we're in an uptrend. And our market trend model is bullish on all time frames. So I have learned always be thinking about what could cause this trend to change. But first off, we have to respect the primary trend. I think the trend is generally positive here. There are plenty of things not to like about this recent breakout. I would say the lack of breadth support, the lack of volume certainly stand out to me. But again, on a pure trend basis, trends are up. And as long as we keep making higher lows, this is a pretty constructive tape. Enough to push the S&P up 0.8%, enough to push the NASDAQ up 1%, and the Dow up about 0.7%. So all the major indexes doing pretty well. Small caps, which have been outperforming large caps year to date, continuing to outperform. That trend persists with the S&P 600 small cap index up 1.5% today. The only red you see on the front page, besides Canada being slightly lower, is the VIX coming off a bit. So the VIX down almost a full point. We're down in the 17s. Again, anything below 20 is a low volatility environment. Yesterday, we saw the VIX pop higher as risk assets rolled over. We had a bit of a downer on Monday for risk assets. The VIX popped slightly above 19 around midday Eastern time, but closed down around, in the 18s. Today, we're in a 17 handle, so volatility coming in. As long as volatility remains low, this market's in a pretty stable footing. Interest rates coming off today. So all the things we talked about yesterday, most of those kind of reversed today, with one exception I'll show you in a minute. But interest rates coming off a bit as bonds and stocks rally. So the TLT, which is a Treasury bond ETF, up just over 0.5%. Rates generally came lower. We can see the 10-year point which was around 445 yesterday, down closer to 4.4%. The long bond yield is back below 5%. So rates remaining lower is pretty encouraging. Generally, we've been seeing rates creep higher. I would argue that, in a lot of ways is sort of pricing in that the Fed unlikely to be cutting rates anytime soon. And to be honest with you, I'm hearing more talk about potential rate hikes down the road as opposed to rate cuts. But it tells you, again, with the new Fed chair coming in, there's a pretty wide range of expectations because we really don't know what to expect until that new era kind of formally begins. So this next Fed meeting could be interesting. Definitely will be, because it'll be a different vibe, and certainly a lot of attention will be there on the new Fed chair's approach to this whole game. The dollar index essentially flat for the day. That's one of those other red lights we look for, red flags we look for. Spike in volatility, spike in the dollar, spike in credit spreads. Those are three kind of spikes you don't want to see. The dollar, the volatility, and credit spreads. That would imply currency markets, options market, bond markets. Any one of those are signaling some uncertainty. But for now, flat dollar, something to continue to watch. In the precious metal space kind of mix here, you can see gold actually finished up about almost 1%. Silver actually gave back a lot of gains out of the open. So while equities were higher, bonds were higher, silver actually flat for the day. In the commodity space, of course, the real news was the weakness in energy. Again, energy is a volatile series right about now. It is volatile because it is tied to, it's basically headline risk tied to what's happening in the Middle East. I guess what the market is telling you with crude oil prices coming down today is this whole Strait of Hormuz thing is not as big of a deal as some may have expected. It looks like some ships are getting through. It's a trickle, though, not a flow. From the way I would summarize my review of a bunch of commentary on the topic, people that know it better than I do. Having said that, market's telling you to lighten up a bit. Crude oil prices down 2.3%. We're going to see that continued inverse relationship, I would say most likely, between crude oil prices and equities. When crude oil's down, stocks are up. When the stocks are down, crude oil's up. And that's probably what we're going to see for the foreseeable future, as long as the situation in the Middle East remains top of mind on the macro side. Tell you what, cryptocurrency is starting to kind of do their own thing and mostly drift higher. Bitcoin back above 81,000. It's actually just above 81,600 as we're going live with the show here after 5 p.m. Eastern. Ethereum prices up 1.5%. We can see that the top 10 cryptocurrencies tracked on the stock charts platform all in the green today. Bitcoin and Ethereum are the two that we follow the most closely. And chart of Bitcoin continues to be kind of in a position of strength. That break above 75,000 was enough for me to take sort of initial position in my portfolio, and continuing to happily hold that as Bitcoin continues to push higher. So interesting that recently Bitcoin has gone up regardless of whether stocks are up or down. So they're starting to see a bit of a disconnect there with optimism being reflected in cryptocurrencies. All right, looking at the 11 S&P sectors, great day for sectors, great day for single security breadth, as we'll show you here in a minute. But let's start looking at the 11 S&P sectors. As we can see, 10 out of the 11 S&P sectors were in the green, and honestly, 9 out of the 11, we'll say 8 out of the 11, because financials and utilities were basically almost identical to yesterday. So a number of sectors kind of in line with yesterday's close, but definitely way more up than down today. At the top of the leaderboard, we've got technology continuing to re-exert its dominance in our U.S. benchmarks. It's now up to around 36, 38% or so of the S&P 500's weight is just the technology sector, up 2.2% today for the XLK. Obviously, chip makers a huge part of that. Select software names doing better than others, but overall, it's been the AI trade, the chip makers really leading the way higher. Materials number 2 up 1.7%. Finding some interesting charts in the materials sector. We highlighted, I think, Linde, L-I-N, yesterday, and I believe I grabbed a different one today. I forget, because I was grabbing them a little earlier this afternoon. Industrials number 3 up 0.8%. The lagging sectors today, communication services, the XLC, the only one really negative today, just down 0.4%. Utilities and financials, as I mentioned, were basically flat for the day today. Here, looking at the stock breadth, looking at advancers, decliners, pretty decent day, particularly in the NYSE, 68% up to 30% down. In the NASDAQ composite, a little closer to neutral, but generally this is a pretty strong breadth day with breadth in the small cap space. The strongest, about a 3-to-1 ratio, advancers versus decliners. So breadth remains strong. Small caps continue to outperform large caps. And if you told me that early May 2026 AI trade is going to be on fire, mega cap, Mag 7 types of names, with some exceptions, generally looking pretty good, particularly the AI winners and the ones that are really seen to be leading that charge forward with aggressive spending, but also incredible amount of earnings generated by those revenues or in the pursuit of those revenues. If you would have told me, given all of that small caps would be outperforming large caps, I would laugh at you. But here we are, and that's exactly what's happening here. So friendly reminder that what you think should happen or could happen based on whatever metrics you believe, never nearly as important as what's actually happening. That's why our investment process is built around market awareness, making sure that we regularly review which sectors and which stocks are working and make sure that we bet accordingly. I got a lot more bets in small caps than in large caps at this particular moment, and the outperformance in the small cap space has been a major reason why. All right, looking at the Magnificent Seven and friends, we've got Apple and Broadcom both with some strong up moves today. Apple up 2.7%, 2.6% for Broadcom. Alphabet up 1.4% on the downside. Netflix less and less feeling like a friend to these other stocks because it's diverting so much. I mean, it's a different chart in many ways from most of these, which will look a lot better. Netflix now becoming probably the least attractive charts out of all these, with a recent gap lower and falling after that, down 3.4%. NVIDIA also down 1%. So NVIDIA sort of ignoring the whole chip makers are thriving theme that we've been observing here in the last month, continuing to lag behind the semiconductor group, and just today down on a day when most of those names are moving to the upside. All right, we will look at the heat map here in a moment. As a reminder, we're live streaming on 4 platforms, and if you can drop a comment anywhere where you're watching the show live, you are welcome to ask questions. I can see those here on my live stream platform. If you're watching the show later on our YouTube channel, thanks for watching. I appreciate it. Drop a question in the comments section. We'll do an all mailbag episode Friday of this week, and we'd love to answer your questions there for sure. All right, looking at the heat map. So again, what I love about a visualization like this, I sort of start with what draws my attention, like what stands out. And then I also like to think about the general complexion of the page. And then I like to focus on individual stocks and groups. And so what immediately draws me is obviously the strength in technology. And that's not new. That's actually been a general trend here for quite some time. But just the up moves that you're seeing in names like Intel is pretty astounding. Intel up another 13%, just pushing past $100 a share like it doesn't even matter. SanDisk and Qualcomm both up about 11% to 12% today as well. So we're seeing just some outrageously strong moves to the upside. And it's not just there, right? I mean, we've got Microchip Tech, MCHP, making a new 52-week high. The number of 52-week highs in this sector today, probably not surprising if you've been following the group, but it's kind of everywhere, right? I mean, there's just a lot of names doing quite well here. So in a sector that's doing ridiculously well, and where names like Micron, I saw someone mention Micron is treating you well. Absolutely is, right? And Micron is such a great example of why I look for breakout. Like when I look at the chart of Micron, like this is why I scan for 3-month highs. It's looking for this move right here, right? When you see the new high, this is when it gets above 475. We're up to 640 already. Now, granted, this is a group going vertical and a theme that has just gotten everyone's attention. There's a FOMO that is palpable as these stocks are gapping higher day after day. However, it's a reminder that breakouts can be really profitable. And this is why breakouts are a core part of my process. I remember when I left Bloomberg and went to Fidelity, this was back in 2008, just before the whole great financial crisis became a big thing that turned out it would dominate most of what I was thinking about as a managing director there for a couple of years before we could kind of get past it. But that's we digress. I really didn't appreciate the benefits of buying big base breakouts. And I met Bill Doane, who ran the technical research department at Fidelity in the 1970s. Bill was kind of semi-retired, writing a newsletter that a number of the portfolio managers still read religiously every week. And I got to meet him a couple times before he passed away, and he told some great stories about the process and the investment process and how they pick stocks and all sorts of things. But to that, the time I met him, he was still looking for big base breakouts, and he showed me examples back 20, 30 years ago on hand-drawn charts about why breakouts work, what they represent, what they mean in terms of new found optimism and an influx of demand. And I never forgot those conversations with Bill Doane. Every time I see a chart kind of like that, I think of some of those conversations, and just a reminder that a lot of times it feels like you're way too late when you're buying a new 52-week high. Not necessarily. And a lot of ridiculous gains come after that initial breakout to new 3-month highs. That's why I continue to do it. Now it's run a ton, right? And I think the problem for a chart like Micron is if you look at any indicator based on momentum, we're very extended, right? And you can see that like the RSI is above 80. If you look at the percent above the 200-day moving average, we're at extreme levels. So, would I want to take a position today? Maybe not. Would I much rather take a position like back here? Yeah. So that's why we always look for actionable breakouts, things just getting started. And then if you miss it, you kind of have to, then you're in trouble, because you either have to wait for a pullback, or you just kind of let it go and you add a position and just use good money management strategies to kind of keep yourself in as long as the trend remains positive. So within that technology sector, and I just wanted to talk a bit about Micron's breakout there. It's worth noting the stocks that are not participating today. Obviously, two of the biggest three names, Microsoft and NVIDIA. NVIDIA has a bit of a failed breakout above 200, kind of coming back below that level, doing what most of the chip makers are not, in that they're pulling back here over the last week. Microsoft, of course, one of the big four names reporting, or five names reporting earnings last week. Microsoft and Meta both kind of dribbling lower post earnings, and so we're seeing, again, lack of follow through to the upside for Microsoft. Meta as well, not looking particularly good. So within those magnificent seven, we're kind of back to magnificent in air quotes, because charts like Netflix and Microsoft and Meta, obviously from a technical perspective, pretty hard to justify. Microsoft could be interesting if we can get a higher low in place. I think that could be a really compelling chart, but boy, it hasn't happened yet. And then some of the software names stand out to me, like Intuit, really just sort of consolidating around $400 a share. Not, maybe a double bottom there, but not really showing enough signs of accumulation, I would argue, to get really excited about it just yet. So technology, of course, remains arguably the most important sector. I mean, we're over a third of the S&P just in that sector, and the biggest returns are coming generally in that largest sector. So you really have to be there, or you're missing out on the good stuff today. If you cover up technology on your monitor, though, there's not a lot of other sectors that look generally positive, except for materials. That was the second top performing sector underneath technology. And if you look at materials, it's the steel names that are standing out right now, like STLD, Steel Dynamics, Nucor, ticker NUE. Mining names have not looked particularly good. Like Newmont Mining is kind of mid-range for the last 3 months. Freeport-McMoRan potentially bouncing off of a support level, but not quite there. I think the most interesting charts are something like DuPont, right? Ticker DD, kind of getting back above the 50-day moving average today. Nice move higher. They're actually an earnings name today, and a nice upward surge, up about 8.5% today. I like the fact that we're breaking higher. I like the fact that we're making a new swing high. I love the fact that the RSI is pushing above 60. That's one of those things when a stock is sideways, a breakout with a surge of momentum is often a really good initial signal of a move higher. I think that's it on the heat map. Other than that, kind of a mixed bag of a bunch of different things. But I would say generally, those are the two sectors that obviously stand out in a position of strength. Otherwise, a lot of individual names, a lot of earnings names that we can talk about. And we'll get to some of those charts here momentarily. Before we do so, I do want to give a shout out and a quick thanks to our friends at EPS Momentum, sponsoring the show this week. If you go to marketmisbehavior.com/EPS, you can learn more about their tool that is really built on, it's a platform built around the price earnings relationship, looking for strong price actions supported by strong earnings. Some of the podcast interviews I've done recently, including the one I just did earlier today, which you should have out later this week, we talked a lot about earnings and the companies showing improved earnings expectations. And the quantitative approach at EPS Momentum is built to try to help you capture that. You can learn more at marketmisbehavior.com/EPS, how you can use their scanning tools, how you can look at sector rotation, look at power days, which is a surge in price supported by strong volume. And thanks so much to EPS Momentum supporting market misbehavior. All right, here we have a daily chart of the S&P 500. You may note we've made a new closing high today. On an intraday basis, we did slightly outperform Friday's high, which was that shooting star candle. Turns out that was a one-day drop that we experienced on Monday, but today back to all as well, with risk assets continuing to push higher. And again, we can debate whether or not the S&P's uptrend is justified by whatever fundamental or macroeconomic thing you think would justify stocks being higher or not. But I would argue the reasons why the trend is happening is never and nowhere near as important as recognizing that the trend is happening. I've watched investors get into a ton of trouble making bets, ignoring what the market's doing and just thinking, here's what I see over here. Here's what I heard. I think that's going to happen. And I'm just going to assume that that's going to play out. I've learned, listen, that's great to think about. And it's important to think about the relationships between different factors. But at the end of the day, if the market's going higher, I'm going to want to own stocks. And if the market's going lower, I'm going to generally not want to own stocks. And so understanding and respecting the trend is primary in importance for me. Our market trend model remains bullish on all time frames as of Friday's close. The RSI on the S&P 500, pretty unusual. I mean, it's been a while since we've seen this pattern where the RSI is just kind of right around 70 for weeks on end. But we're definitely seeing that. The strength in the equity markets, I mean, again, what it means is that the market is not seeing conditions in the Middle East as being a huge issue, not pricing in huge disruption based on the supply of crude oil and all of that sort of stuff, not pricing in big hits to the economy. And I would argue one of the main reasons why the equity market's not pricing any of those things in is because companies aren't really adjusting their expectations, right? And until you start to see earnings and particularly forward-looking estimates and forward-looking guidance start to be downgraded because companies and analysts are looking at down the road 6 to 12 months and saying this is going to be a challenge for this company. Like, we're not seeing that. We're seeing revenues go up. We're seeing earnings go up. And that's one of the things that I talked about earlier today on the podcast, right? It's not just that revenues are strong, which they are. And it's not just that spending is aggressive, which it is. It's the fact that companies are actually earning tons of money and continuing to be upgrading that. Not everyone, right? With some exceptions, but the companies that seem to matter and the companies that are driving this euphoric rise in risk assets appear to be making plenty of money, and the earnings are backing that up. So until those expectations change, the market appears to be heading higher. Now, again, I would tell you we're one bad headline away from the market rotating lower very quickly. And we've seen that certainly with what happens when, if and when conditions become more volatile. So, remains to be seen. But for now, we're not seeing those negative headlines and we're not seeing that negative trend. The market is moving stronger on strong momentum. It's pretty encouraging. Volatility remains low. And again, I have three general things. I ask anyone I interview on the podcast, I always try to get in some version of the question, like, what would tell you things are going to get worse? Like, what's that one thing you want to keep an eye on? And having asked a lot of people those questions over the years, there are three things I've kind of settled in on in this kind of environment. And the two that are most, I would say, directly tied to equities would be volatility and credit spreads, right? Is the options market telling you to be nervous? Is the bond market or the bond investors telling you to get nervous? And at this point, neither of them are. Volatility remains low. Credit spreads remain fairly narrow. And so market is not pricing in a bunch of negativity right about now. The VIX spikes above 20, like we started to see in February of last year. That's what a warning sign could look like. Even if the S&P is holding its ground, if you see volatility start to increase, that tells you we might be leaning into some period of weakness. We're just not seeing that. We're seeing the volatility remain fairly low here. Again, that can change tomorrow, but best I can do is report on what's happening right here. That's where it's at. Crude oil continues to really chop around here. And what's interesting about the chart of crude oil, I've seen comments saying, look, it's not going up, so that's good. That means things are kind of okay. But let's be clear here. Things are at best okay. And I would say if crude oil just kind of bounces around $100, $110 for a couple months, I mean, would it be way worse if crude oil got to a $150 barrel or $200 a barrel? Yes, I think that's where it would be very clear, significant disruption would be felt in the near term. I would expect prices would explode, travel would dry up, people would be very, would start adjusting their behavior. But crude oil right around these levels just becomes annoying. And I would say the longer that it remains elevated at this point, it just starts to create issues down the road, right? At least that's a reasonable expectation. It's hard to imagine that there wouldn't be some negative impact to crude oil prices kind of remaining elevated. So great that it's not going up. Would it be better if they were going down? For sure. For risk assets, I would say crude oil going down to like $80 a barrel would probably be better for equities here, certainly in terms of expectations. But the problem is just remaining flat, remaining sideways, I would say is generally a negative sign for stocks. We would hope to see crude oil prices start to come down as conditions in the Middle East start to improve. We're not really seeing that yet. We're just seeing literally a stalemate in terms of what the crude oil price is representing. Bitcoin continuing to impress. We sort of started, getting serious back here as we're getting above 75,000. That was our line in the sand. We crossed it, so we took a position. Overall, it's continue to work, right? In a chart like this, higher highs and higher lows, great chart, right? Good chart until proven otherwise. Problem with Bitcoin right now is we are nearing kind of the level. We're nearing the 200-day moving average. We're also nearing a 61.8% retracement back up to the January high. So we take the 2026 range, which is the January peak and the February low, 38.2% lined up pretty well with these short-term peaks in March. We had a good pullback of a couple weeks after that. We then surged above there. We've gotten above the 50% level, and now we're getting right up to the 61.8% level. So the 200-day is kind of right in that same range. So would not surprise me if we get some sort of pullback below that significant confluence of support, as what we would say. But boy, Bitcoin above 84,000, just another kind of check in the uptrend column. And the momentum has been excellent with the RSI getting near the overbought region for the first time since January. All right. Hey, listen, I'm always happy to share with you things that don't look great. I find that as part of the most important things you can do as an investor. Number one, define the trend, take a position to express your recognition of the trend. The trend is up right now, I think undeniably, but always looking for things that would tell you, okay, these are some things that are not perfect, which tells me either to watch them for, potential confirmation, lack of support for the breakout, or if they would start to improve, that would be like an all clear. Okay, great. Some things didn't look good initially, but now are starting to improve. Things were even better. So I think these are great confirmational tools to monitor. One thing that is not supportive right now is the fact that offense is underperforming defense. And the classic way that I do that is looking at consumer discretionary versus consumer staples. The thinking behind this, the thought behind this is things you want, consumer discretionary. These are, basically companies that benefit when consumers are kind of spending money and happy to do it, and they're traveling and they're buying new stuff and all as well. Consumer staples are relatively immune to economic shifts because they're things you kind of always need, like cleaning products and beverages and stuff like that. So when offense is working over defense, that tells you that in the consumer space, we're in a risk-on position, meaning, things you want are outperforming things you need. That's pretty common in a bull market. In a bear market, it's much more common that consumer staples outperform because people just aren't really spending on the discretionary purchases, or at least the expectations looking forward is that that's going to dry up a little bit. So in the month of April, right, second half of April, these ratios both started to turn lower. And this is the cap-weighted version in the top. That's the equal-weighted version at the bottom. And so you're seeing weakness in this measure of offense versus defense. So while the S&P is going higher, it's telling you consumer discretionary is not really doing what you would expect it to do, and or consumer staples are doing way better than you'd expect them to do if things are all great, right? So it's giving you a things are not great sort of vibe. So what I would tell you is the more that this goes down, the more that this suggests that this recent breakout is one to be skeptical of and not one to be excited about. However, if these ratios would start to tick higher, that would tell you, much more interesting and maybe validating the recent breakout. Now, the cap weighted version, the problem of that is it's dominated by just a couple names, Amazon and Tesla in particular. But the equal weighted version kind of takes that mega cap overweight off the table, and that's still going down as well. So offense underperforming defense here. Now, it's not just that consumer discretionary is not doing great. We're also seeing some consumer staples that are doing really well. We highlighted ADM, Archer Daniels Midland, maybe last week or maybe yesterday, I forget. Here's Bunge, ticker BG, in that same food products group. Briefly made a new 52-week high today. It did actually close right back down around 130. So very close to having a significant breakout. I'd like to see the RSI continue above 60, but pretty decent setup here, potentially with a break to a new high on improving momentum. So charts like this really starting to, to be impressive. And that's in food products, which is one of the, kind of defensive areas of the market, again, within the consumer staples sector. This is an interesting ratio. This is the Qs versus the diamonds, right? And this is looking at the NASDAQ 100 versus the Dow Jones Industrial Average. We're looking at the last, 2.5 years, almost 3 years here, it looks like, as a way of just, sort of recognizing this trend. So the bottom panel is the S&P 500. The top panel is that ratio of the Qs versus the diamonds. So what you're going to notice is the correlation between these two is pretty strong, meaning when the S&P is in an uptrend, the Qs are generally outperforming the diamonds, right? The NASDAQ's outperforming the Dow. When the S&P is sort of rotating lower, you can see that the QQQ tends to underperform the Dow. Really interesting how this ratio started to break down in Q4 of last year while the S&P was pushing up to 7,000. This is one of those great early warning signs that things were not great in this ratio. Now, what this plays on is the idea that growth stocks, particularly like technology and communication names, tend to do better in a primary bull market. When the market's going higher, the growthy stuff has generally dominated. And that's been the case now for a number of years, as this chart, I think, very clearly demonstrates. This ratio is going up big time, right? And it shows you that the NASDAQ 100, the leading growth names, kind of outperforming other areas of the market. As long as that ratio continues higher, we're at a pretty good uptrend. Now, it's important to note that at the last major peak, which is going into Q1 of this year, the Qs to diamonds ratio started to turn down a little bit early. I'm not seeing any of that divergence right now, but that would be certainly something to look at. And what that would imply, given the rally, the surge that we've seen in growth, is that growth stocks are really starting to lighten up a bit. There's a momentum ETF that I often get questions on, MTUM, and this is a pretty simplistic quantitative approach to an iShares product. And I think it's a JP Morgan set of factor indexes that they use to create these different things. This momentum factor ETF essentially, plays strong charts, right? Stocks that score well based on their momentum factor. It rebalances twice a year, I believe, in May and November. So it's actually set to rebalance either very soon or very recently. And I forget exactly when the date is. I'll have to look at that because I forget exactly when it is. But I wanted so the MTUM ETF, the momentum ETF, broke out in April, gapped higher, and just has been lights out positive. So always remember, it's helpful when you're looking at an ETF to dig in next level. So this is a product called Koifin, which is one of my kind of go-to products that I use. I'm looking at the momentum ETF, and I'm just looking at the holdings. We can see that 46% of the ETF is technology, just that one sector. So it's almost half of the momentum factor ETF. After that, you've got industrials with about 15%, financials about 10%, and then a number of other sectors, in smaller amounts. So this is a technology ETF at this point, even more of a technology overweight than the S&P. Your top 5 positions, if you buy this ETF, Micron, Broadcom, NVIDIA, AMD, and Intel. Now, a couple of those names we've already highlighted some of the strongest charts we're seeing in technology. So I think it's helpful when you see like a momentum ETF, you're like, oh, this is a great kind of different, ETF to include in the portfolio. I mean, you're kind of doing the same thing. You might as well buy the QQQ. It's not much different from that, is my point. And if you look at the industries, by the way, semiconductors make up about a third of the ETF. And you can see the larger weightings in some of the larger names. So this is an ETF that basically is weighted to all the strength in technology and then some random other things, aerospace and defense, the second group at 6%. But it's essentially a semiconductor ETF with some other things mixed in there as well. Having said that, chart's going up. And so is this a great way of diversifying away from semiconductors? Obviously not. Is this an ETF and a chart that demonstrates the strength in that space? Absolutely. So I think that's important to recognize. Palantir, yeah, I mean, we were looking at this chart yesterday, and I just wanted to show, after the earnings, I mean, the earnings were not particularly negative, and I think that's going to be what is a surprise. I think the way that this market uptrend ends, and I don't have a crystal ball any more than you do, but one potential scenario I could see is that stocks like Palantir, which on the surface, if you read about and learn about what Palantir does, and you think about the impact that the company has and can have, and just the growth that it's experienced, if you look at the earnings and the revenues and all of that, which have been absolutely ridiculously positive, it makes no sense that the stock is down and gapping lower, down about 7% today after pretty decent earnings. And so I think that's the thing, right? I mean, what we also have to remember is at some point, investors start to feel like something has gone on way too long, and they start to, ridiculous valuations, ridiculous uptrends are validated and explained away all the way up. But then on the way down, it's like, oh, well, I guess that was too much, right? I guess there's a limit to how high we can bid up these companies. Having said that, I would say from a technical perspective, and this is a neutral chart, and this is what the sort of consolidation phase that I'm illustrating is meant to demonstrate. I think the optimistic view of earnings this week was that there would be such great news, buyers would surge in and push Palantir above the 200-day. That obviously didn't happen, but are we a really bad chart yet? Like, we're not yet, right? We're still kind of sideways. We're breaking down potentially through support. That's 125 would be the level that would confirm that. For now, it's wait and see. We've got neutral trend, neutral momentum. The problem with owning Palantir here is the opportunity cost, right? The fact that you're not owning something like a Micron, which is going up 11% a day. You've got Palantir, which is basically sideways. So not losing money isn't bad until you think about the fact that your capital is tied up in things that aren't going up. So what is going up? Packaging Corp of America. This is in the material sector. This is not surprisingly, if you're not familiar with the stock, it's in the containers and packaging group. PKG is making a new swing high today. I like this rotation. After testing the 200-day, sort of chopped around a little bit. The momentum was more negative. Now we're seeing a bit of a move higher. We broke out of moving average limbo, close to making a new 1-month high. The RSI right at that point where I start to get interested. So I think, PKG moving a little bit higher, RSI pushing above 60, pretty compelling. I like the bounce off of the 200-day moving average. So there are charts out there starting to turn higher. Indicators like MACD or PPO, if you're not familiar, can be pretty helpful as well. All right. Those are the charts that I prepared. I've got time for a question or two. I'm going to go through very quickly. And let's at Wombats and Coffee. Hey, A+ handle. I love the creativity. I love the image. Well done. Volatility. Do you place any value in average true range distance to 50-day simple moving average? Yeah, I kind of alluded to that a little bit earlier with one of those, I think those Micron that we talked about, right? So, I think there's two ways you think about a chart like Micron that's been going up a lot, right? There's the trend and then there's the momentum. And a lot of people think of those as the same thing, but they're really not, right? The trend for me, when I think of the trend in a stock, I'm thinking of trend following. I'm thinking if the trend is up, my goal is to just recognize that trend is positive. And my simple analysis is, are we in an uptrend based on some way that I would validate? The moving averages are sloping up. If I apply my market trend model to Micron, we can see it's bullish on all time frames, right? So it's just a stock that's going up and has been going up for a while now. So the trend is generally positive. Momentum is not about the trend, which I would argue the trend is kind of the direction. The momentum is how we get from point A to point B. And are we at the upper end or the lower end of kind of that channel. So if you're looking at the chart of Micron, I'll get to your point because I think your question is a great one. So I'm sorry, I'm kind of giving a long-winded answer. I'm going to crudely draw, right, like kind of this channel. So I'm again, just not spending a lot of time optimizing this, but kind of drawing this general trend channel that we've been in since the April 2025 low in Micron. So we've been arguably in a pretty consistent uptrend that whole time. But during that uptrend, we've had these periods where at the upper end of the range, we've had these periods where more at the lower end of the range, right? A lot of times when we're kind of at or near the lower end of the range, you can see the RSI kind of gets down around 40 or 30. You can see when we're at the upper end of the range, we will often see the RSI become overbought. So we can, this is a momentum indicator, just kind of taking that. I mean, it's not doing exactly this, but it's kind of like taking that channel, putting it down, normalizing it, and just showing you where we're at kind of within the trend. So the trend analysis tells me we're going up. The momentum tells me we're going up, but we've been going up we're now at the upper end of this range. So is now the day I probably want to be taking a new position on a stock? Like probably not, right? I generally, if we're up here, I want to wait for us to be down like toward the lower end. And so that's why with stocks in a good uptrend, waiting for pullbacks to a 50-day moving average, waiting for the RSI to get down around 40, those are some of the tools that can help us buy in on the lower end of a good channel going higher. So the trend analysis is what helps me kind of define, we're in an uptrend. The momentum tells me that. And your question was, what about percent from a moving average? Yeah, I would say that's in the same bucket as like the RSI, which is basically telling you where we're at within this trend. So it's agnostic as to whether the trend is up or lower. It's just basically where we at relative to that range. And I would say with anything like Micron, the problem is we're kind of at the upper end of that channel, and I think that's a problem. One other question that I saw, and then just look past, and I apologize so much. I did not have a candle quiz today. Sorry, I often do, but I couldn't get one in there today. 3P investor, this range bound stock is good for options. So that's one of the things that I'm always super jealous of traders that trade options. I do not. I'm often asked why you don't trade options. The answer is I worked at big firms that had, beautiful and well-resourced compliance departments that wouldn't let us do anything cool in our portfolios, our personal portfolios. The idea was any of our great insights or skills should be applied to our shareholders or clients' portfolios and not to our own. I get that idea for sure, but it definitely meant you had to create a personal investing approach. You either had to outsource it so someone else did it, and they had the same restrictions you did, pretty passive investing, or you just had to find things you could do within the framework. And so that's why I built my process around momentum based on rebalancing regularly across pretty large liquid macro ETFs that were compliance friendly. And so that's kind of the bulk of my process is built around that. So I never really incorporated options because I couldn't with the firms that I worked at when I was really forming my investment process. Some point, maybe I get all excited to learn a new set of skills, but I will tell you, having worked a lot with options traders and interviewed them over time, yes, something like this, where you have kind of a range-bound environment, perfect opportunity for like a straddle or strangle or one of those spread, positions where you can bet on a stock having big volatility in either direction. You can bet on a stock having relatively narrow volatility. And charts like this that sort of give you a structure really would be a natural extension to develop an option strategy that would play off of that structure, and betting on the market mean reverting within those extremes. Absolutely right. Not something I do personally, but I have seen it done, and I think it's pretty impressive. Folks, that'll do it for today. Thanks so much for joining me today on Chart This with Dave Keller. Thanks for the thoughtful questions. I didn't get to all of them, but I will add the remaining questions into our mailbag. We're planning an all mailbag episode on Friday. Don't miss the latest episode of the Market Misbehavior podcast with Wyckoff expert Bruce Fraser and relative strength expert Tom Bowley. Two awesome mini master classes in trend analysis and technical analysis. That'll do it for today. My name's Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Have a great night, folks.